Hey, this is Herndon Davis, your mortgage broker with MortgageRealEstateServices.com. In today's video, I want to talk about how to get your rental projects or rental properties financed. All right, we're talking about buying a house or a duplex or a triplex or fourplex, 1 to 4 unit homes that you rent out for passive income or for rental income. All right, so there are basically two different avenues or two different areas that you can go to for funding. There's the conventional side and then there's the non-conventional side. So let's talk about the conventional side first. Conventional loans are basically loans that conform to either Fannie Mae or Freddie Mac. All right, so they have their advantages and disadvantages. The three major advantages for conventional loans is the fact that they do offer really competitive market rates. All right, so if you're looking for interest rates that are pretty low, this is the area that you should go to first. They also allow flexibility in terms of their years in terms of paying them off. So you could probably get a 10-year loan, a 20-year loan, or a 30-year loan. So if you bought a great big fourplex and you want to spread out the payments and have lower payments, you can do that with a 30-year loan, fixed rate. Or if you bought a small house and you don't want to spend 30 years paying an $80,000 house off, pay for it in 10 years instead, or early if you want. So they have really great flexibility with that. The other advantage is that typically they have lower closing costs. So those are the three major advantages of going the conventional route. And by the way, as a mortgage broker, I can assist you with that. I broker to the conventional side as well as the non-conventional side. So I can help you with either way. Now, the disadvantages with the conventional loans are the following. They place a lot of emphasis on you personally, your financial picture, your financial situation. Okay, so that's a disadvantage to people who don't have a strong financial picture right now, but are possibly great entrepreneurs, but for whatever reason they don't have the strongest credit profile. So you're going to have a pretty strong credit profile, a good solid credit score of around 630 or above. I would say above, in order to qualify for a conventional loan for rental properties. You're going to also have to have a pretty low DTI ratio. Now, DTI is called your debt to income ratio. Basically, to calculate this is that you take your personal minimum payments that you pay for your credit card, your student loan, your car payments, all those minimum payments you pay every month, and you divide that over your gross monthly income. If you got a DTI of 43%, 0.43 or 43%, that's really high. And in fact, that's the maximum on the conventional side at the moment, 2017. So you really need to have a low DTI. I'm thinking 15 to 20%. I'm hoping more so 15%. Because you really need to have a very strong credit profile to qualify for these conventional loans. Now let's talk about the non-conventional side. On the non-conventional side of the house, I can also broker and help you to find the right private money lender, the right types of programs that fits your investment rental property the best in order to get you financed for that rental property. All right. So the biggest advantage to non-conventional financing is the fact that we look primarily at the property itself and its ability to generate income, specifically net income, which means that we look to make sure that you can pay the mortgage and the interest payment on the property above a certain percentage. So that's called the debt service coverage ratio, the DSCR. Okay. So basically, let's say you have a property. It has 4 units. You get $1,000 per unit. That's $4,000 a month times 12 months. That's $48,000. Now we have to back out the fact that you have to pay for mortgage insurance on that property. Also, you have to pay your taxes on the property itself. And so once we take that out, you get what's called net income or net operating income. And we just simply divide that over the total amount of mortgage and interest payments you make on the property throughout the year. Now, if you have a 1.0, which means that your net income over your total mortgage and interest payments equals 1. You cover exactly what's needed, okay? But we really look for a ratio of 1.25 and above. At 1.25 and above, it says that you're bringing in 25% net income above what's needed to pay your mortgage and interest payments. Okay, and that's really important that your property have a 1.25 or above ratio. The higher the ratio, the better, because that gives us a lot of confidence in your ability to pay the bills, basically. So it's really important that you have a 1.25 or above ratio. The other advantages to non-conventional funding is the fact that you can get same-day decision making right there on the spot. Okay, and then the final advantage is the fact that you can close in 14 days or less, even on the non-conventional side. While on the conventional side, it takes at least 4 weeks or so to close. So if you're in a hurry to get the property under your belt, situated and ready to go to the next property, definitely non-conventional is the way to go. Now, there are disadvantages on the non-conventional side of the house. Chief among them is the fact that you will pay a higher interest rate on your loans. I believe on the conventional side, you will pay probably market value or slightly higher, but on the non-conventional side, you will pay probably 6, 7, 8, or 9% or more, depending on your credit score, which is a second disadvantage. The lower your credit score, the higher your interest rate. No brainer there. But so if you have a 650 or above, you're going to pay probably around 7%, 8%. But if you've got a credit score of 600 to 650, you're going to pay more than that. So it's really important to keep your credit score around 650 or above. Okay? And also the third disadvantage, depending on which lender I match you with, if you have little rental experience, rental management experience, they will hike the interest rate a little bit higher. So your interest rate on your very first rental property may be higher than the interest rate on your second and third rental property that you buy. So there you have it, the major differences between conventional funding and non-conventional funding. On the conventional side of the house, we'll look more so at the personal financial picture of the person applying for the loan, while on the non-conventional side, we'll look more so at the net income being generated from the property itself and the ability for that property to pay for the mortgage and interest payments on the property above 25%. All right, so there you have it. Feel free to reach out to me. You can email me at any time or call me at herndon@mortgagerealestateservices.com. Again, that's herndon@mortgagerealestateservices.com. Call me at area code 832-457-8951. Again, that's 832-457-8951. I look forward to hearing from you soon.